Hello, everyone, and a very warm welcome to today's major markets update for Friday, October the 4th, 2024. We had a nice response to the NFP data. Now, I'm 1000% certain that all this extreme job creation will be revised downward next month. That's a whole other issue. Meanwhile, I also want to address something else, and that is that we need to know that trading is speculating. All right. A trader or investor is a speculator. What do speculators do? You speculate, so you take a position in an asset, and by doing so, you speculate and predict on what the price of that asset might do. Nowhere does it ever say that trading is a certainty. There is no certainty in trading. Why? Because we're dealing with a complex system. It is stochastic, so multivariable. It is probabilistic, so there's a chance it can go up and a chance that go down. And of course, we have a multitude of other factors that go into play. So trading is speculating. That brings me then to the Elliott Wave principle and how to use it for your trading. Okay, because we are speculating, which means we are dabbling with uncertainties. We think it will go a certain way, but we're not entirely certain. That's trading. There is nobody that can say anything with certainty about the markets. Nobody. Even the best are at the best 80% of the time correct. That is the highest you probably can get in forecasting where the market will go next over the next hour, day, week, month, year, decade, you name it. 80% of the time, people are at the most correct. I say to myself, 70% of the time, you got to give yourself a little bit of leeway. Anyway, so when you speculate, you take a position and you speculate or predict on what the price of that asset will do. If you take a long position, you speculate that it will go up. If you take a short position, you speculate it will go down. How can you then use the Elliott Wave principle? Well, it's going to be very simple. Okay. We're going to go straight to this is yesterday's trade alert or major markets update, not a trade alert. We'll get to the trade alert in a moment. We've continuously said we continue to favor a bullish stance. All we did was outline our favorable bullish stance and also shared with you the alternative. The alternative, we've constantly said, this is our insurance premium, right? This is your racetrack insurance. If you take your car out on the racetrack, you need a special insurance. A regular insurance won't cover it because you're really putting yourself deliberately in extra danger. So you take a racetrack insurance. It's just an insurance in case you crash. You don't want to crash, right? But it happens. And that's why you take the insurance. So as I said, we had a preferred roadmap. Okay, that is what we prefer until proven otherwise, which would be in this case a drop below the September 6th low. We were looking for a pullback and then higher prices. Well, most likely that pullback has completed. So if you have this to your use this to your advantage. If you have this knowledge, you know, all right, we still need to consider a bullish stance, and we just take the bearish alternative as a FYI in case things go wrong, but you don't use it for your trading. I see so many people that don't know what to do with it. I cannot write it any clearer than that we favor a bullish stance contingent on holding above the September 6th low. If you don't know what contingent means, then please look it up. I can't help you any further. But this is really the crux of the matter. There's nothing else to the market. It's really dumbed down to the simplest preference for going higher. We did so today. And a preference for example, a dip and then higher prices. Now, the dip can always be higher or lower than we think it will be. It can be 23.6% retracement. It can be 76.4%. That we don't know. The dip can subdivide, right? Also that we do not know. That's why we use our warning levels above or below. Certain price action will be invalidated. So we use that to our advantage. If you have difficulties with it, I can highly recommend you using our ETF Trade Alert service. Okay. This will just give you a simple email. Example is here. You can go to our website on what you will get. Short-term, intermediate term, long-term. Short-term is day to weeks. Intermediate term is weeks to months. Long-term is months to years with the appropriate ETF. It will simply be updated every day. And it says, buy a full position in this, hold it, raise your stop. Very simple. You don't have to do your homework. You don't have to sit through noisy chat rooms. None of it. You don't have to do any of your analysis. All you need to have is discipline and tenacity. Why? Because there will be losing trades. Our UDOW SDOW system had, I think, 3 or 4 losing trades in a row, all of them small after many winning trades. It happens, but you got to stick with it. Why do you have to stick with it? Well, here's our performance this year for the short term for the SPXL, SPXS pair. And here, this is for the TQQQ, SQQQ pair. As you can see, both trading systems are up almost 40%. Okay, we actually took a small loss on a SQQQ and a SPXS trade. It was the first losing trade since April of this year for the NASDAQ 100 and June for this year for the SP 500. Amazing. Now, as you can see here, our short-term trading system didn't do so well February through April. You were down almost 10%. Most people give up here and they forgo all the gains here. You cannot give up here. I would not sell this service if it doesn't work. We were up 65% or 66% combined for these two last year. We were up 20% for the S&P 500 and 5% for the NASDAQ 100 in 2022. That's when the markets were down double digits. I think the NASDAQ was and the NASDAQ 100 were down 35%. So that's a fantastic return. Whereas everybody else was losing money, you were making money. And you can say, well, can you do it better yourself? Probably, and hopefully for you, but you will have to do your homework and your analysis and read a lot of tweets, go through chat rooms, all that stuff, get trade recommendations. I don't know what. This is the simplest you can do. All it says: buy, sell, hold, raise stops, etc. That's all there is to it. So yes, there is always a convenience fee. So with the convenience fee, you might not get the greatest returns if you do it all yourself, aggressive calls and puts and I don't know what. This is simple ETFs and we're completely outperforming the market. Maybe by the end of this year, the markets will have caught up. I don't know, but so far so good. And I do want to show, you see here, yes, there will be losing trades and sometimes quite a few. And this is a hard time, but you gotta stick with it. This is why you need to have discipline and tenacity. Okay. And as you can see, from there on out, it went bonkers. And we finally had a losing trade. I say finally, because no system is perfect. No trading system is perfect. So please use this to your advantage. For the listeners at home, use this to your advantage. If you can do better, kudos to you. But also look at what is required for your input to get a better return. There's always a trade-off. A lot of input from you, probably higher returns. Lesser input, lesser returns. But this is as good as it gets. You get just a daily email just before the market closes. You can either buy at the close or in the after hours, and our system's got your back. This is just a short term. We have intermediate term, long term, whatever floats your boat. I really wanted to point it out. Super simple, just divide it by indexes, everything. And the reason I do it is not to upsell anything, but I want to make sure it's a win-win. You win, I win. All right. It's just a little bit over $100 a month. If you have $10,000 and you put it in every single trade, you would be up right now $4,000 and you'd spend probably $1,000. So you still be up $3,000. That's it. Spent $1,000. That's me. That's the convenience fee for not having to do anything. That's what you pay for. Right? That is just fantastic. Excluding intermediate term, excluding long-term trading signals as well. Long-term, you of course get also dividends paid out on your SPY and then on your QQQQ. That good stuff is all included. Yours to keep, reinvest it, cash flow, whatever you want to do. It's all good. Even the SPXLs will pay dividends if we hold through a dividend period. Okay? Fantastic. And I cannot point it out often enough. So once again, that's for you to use. Supplement your own trading with it before we even go to the indexes. If you have problems even understanding what I'm saying with all the Elliott waves, this is your go-to. 9 out of 10 people will not have the patience to sit through 2 months of drawdowns. But clearly, every single time, the system will right itself. The ship will right itself, and you will get very good returns. 3rd year in a row now with our updated systems. I'm very proud of it. I pat myself on the back. Those that are with me are very happy. Yes, unfortunately, now for the Dow, we had a couple of losing trades in a row. It happens. The ship will right itself, and off to the races we go. Once again, I'm not afraid. Just look at the TQQQ, as I showed you, SQQQ, how that turned around. So, of course, if you enter here and you go there, yeah, it's very tough. But trading is not easy. I always, the same with 70% reliability. If I have 10 good calls in a row, it probably means the next 3 will be bad. Maybe the next 10 will be bad. Okay, it happens. And there are times that the market is unclear. And the S of the Dow Jones, you know, as you see here, has been quite messy pretty much the last month. So we've been whipsawed quite a lot. Every time there was a technical breakout, it got sold off. So now we have another breakout, but I don't have a buy signal yet. So then the system gets a little bit more conservative, and we'll wait another day probably before going long. We raise our stops, and eventually know the system has our back. Fantastic. Please consider it. Okay, we're there to help you. That said, let's go to the indexes. I already pulled up the Dow Jones. Did it already bottom for this B wave of the C wave of 505? Very likely, very potential the case. We're back above the warning levels, which is good. We're back above the 10, the 20, the 50. Again, this remains a 100% bullish chart. So that's why we remain a bullish bias. Yes, we would have liked to see the B wave go deeper. That is the ideal one, but it doesn't have to be that deep. It doesn't have to be. It would be great. Sometimes we nail the lows, fantastic. I can, for example, pull up Solana. It bottomed twice in September and in August, exactly where we wanted it. Or in September and today, exactly where I wanted it for potential second wave pullback. Look up my X account, you'll see the post, and off to the races. But if we're in a very bullish regime, you don't really get the pullback you expected, because in a bull market, downside disappoints and upside surprises. So this can easily go to 44,000. That would match, of course, our weekly chart. We've shared this one with you many times. And also this one has, of course, zero indication that we are in a bear market. We're holding above all the warning levels on a closing basis. Again, we have these divergences kicking in, but those are conditions. Those are not trade triggers. Trade triggers are essentially below 40,000. Alternative remains we've topped, but back above last week's high. And of course, we're going to go to 44,000, somewhere around there for potential C is A. C doesn't have to be A, can also be shorter, okay? Most of the time it is, but it doesn't have to be. I want to point out, for example, here, this one. So we have this A wave and we have that B wave, okay? And as you can see, the C is A targets right there, the 100% extension, of course, right there. So that's also very possible. So then we say, okay, we'll set a target zone somewhere around there. That would be a fantastic target zone for this C wave. But it can go much higher. And so 43,000 to potentially 44,000. And again, that matches quite well with the bigger picture. Okay. So the bullish bias remains. So please use a bullish bias and a bullish stance as a cue of do not short. Most of you want to really short this market, but there's zero indication to do that. Honestly, that would, as I said before, for me, require a break below the September 6th low. Until then, I will keep buying the dips. Okay. And there eventually will be a couple of losing trades in a row once I finally realize the market is not trending higher anymore. So NASDAQ and NASDAQ 100. This is our ABC, the bullish wave count. I shared that with you yesterday and before. And we potentially are in also here a ending diagonal fifth wave, similar to the SP 500. We're back above all the warning levels for the bulls. And of course, we can also go to about 20,600 for a more protracted B/2 wave. I cannot yet discern it. This one looks higher. This one looks higher, and only one looks lower. So you gotta continue betting on higher prices. So far, we still have only 3 waves lower from the recent high made last week, A, B, C. You can see it loud and clear, A, B, C. And if we go back above last week's high, again, I'm going to look for 20,600, potentially into the 21, 22,000s. Okay. Bullish bias. Look, we're back above all the moving averages, the 20, the 10, the 50, continue to hold above the Ichimoku cloud. All these simple moving averages are rising. We haven't even broken below the second warning level. So hold your horses. That low here, that was a Friday, is holding very nicely. It's critical. So 90,600 is very critical to hold. That brings me to the semiconductors. I'm just racing through them in alphabetical order. Remember, we were tracking a potential 1, 2, 3, 4, 5 setup that fell apart. Okay, it happens. Again, I cannot predict and forecast everything to the T. But we're back above all the warning levels that we had put in place, with the index bottoming this week right at the second warning level. It didn't even close below it. So again, the first one is a radial lock. The second one is a proverbial shot across the bow. The shot across the bow turned the 1, 2, 1, 2, 3, 4, 3, 4 setup that I shared with you into a ABC. Anticipate, monitor, and adjust is all we can do. If we break above last week's high, I'm going to look here for this gap fill at about 5,700. That has been on my radar for quite a while. Share that with you for quite a while. Just don't have any confirmation yet that's the case. I have no 100% certainty. But what I do know now is that we're back above the 10, the 20, the 50, the 200 day. This still looks reasonably bullish. So we'll keep the warning levels as is. Okay. I see no reason to change my tune. We've bottomed here in this potential B wave zone, filled the CSA target zone. If this is indeed a bull market, downside disappoints. And the alternative remains, of course, that we have indeed topped, but it requires further breakdowns at least below Tuesday's low. Okay, at least. Then, of course, below the Fed Wednesday low. That is a very critical level as well. We break above this high, then this wave count is off the table. So this is your insurance policy for if you want to short this market. But I wouldn't want to short it because we have a bullish bias. But yeah, whatever floats your boat. Okay, this is the preferred path. Could be wrong, but we'll know if we start breaking lower. Until then, it's right. This is the S&P 500. We adjusted the wave count. Initially, we thought it was A, B, but this pullback here is deeper and longer than this pullback. So I think we have a nice subdivision. Also here, a nice CSA relationship targets almost exactly 123.6% extension of wave 1 measured from wave 2, which is quite classic for an ending diagonal. And that's about 60,050 plus or minus a couple of points. So as long as we hold above this week's low, we can move higher. And as you can see, it will only take a little bit for things to break out and propel it into the 6,000 level. So I see no reason to turn bearish. Look at the money flow. Look at where we are. Yes, we were 2-3 days in a row below the 10 days. So short term things were a little bit dire, but intermediate to long term, everything looked okay. The alternative remains this larger B wave, which can still go to about 5,800, but I'm not going to bet on it. It continues to fall apart. I've seen a lot of bearish stuff out on X already after 2-3 down days. Analogy with 2011, higher first, and then we crash 10, 20, 30, 40. I know, it's ridiculous. Well, it could happen. I'm not saying anything against that, but you know, we got to let price talk first and not put our opinion on the market. That's not what we're here for. We're not putting any opinions on the market other than based on our analysis, based on the weight of the evidence. This is a bull market until proven otherwise. So we remain our bullish bias. And once again, we're one of the few that already have much higher upside targets based on the Elliott wave, based on a pattern that most people haven't recognized yet, which is a ending diagonal. Could turn into a simple impulse as well, but we remain looking higher, and that's what we do. So you got the early word, because normally you won't detect an ending diagonal until about wave 3 is complete. because of its overlapping nature. IWM also here bottomed yesterday right at the upper end of the ideal wave B target zone. A CSA relationship would have looked really nice at around 214, but that's not what we got. We got 215. It's a bull market until proven otherwise. So in bull markets, downside disappoints. That's okay. As you can see here, all we did was break below the first warning level. So yes, the bears had a radar lock on us, but that's all they got. They never even got a shot in. Okay, so far not. Alternative remains that we are gonna rapidly decline in this third wave, but the longer it takes, and of course we break above this potential wave 2, this is just potential, and this is an alternative because it's a very unorthodox top. For this potential wave 2, it will require at least a break below yesterday's low and then rapidly below the September 6th low. Only when things go below the September 6th low will I shift everything from a bullish to a bearish wave count using those alternatives that we already have on the table, that are our insurance policies, and that has nothing else than that. Okay, it's not tradable. That's not what it is, because they haven't been confirmed by price. Price is your trigger, and that's really all there is to it. I hope you appreciate it. I might come across as a little bit stern, but most of the time it's newbies, and that's all okay, because we all have been newbies that have difficulty with trying to use the Elliott Wave. Well, if you have difficulty, then try something that's easier. Supplement your own work with my ETF trade alerts. Clearly, the results are in, the proof is in the pudding. Undeniable strong results over the last 3 years, and I hope it will continue. I can't predict the future, and it shows you as well that even with a trading system that is based on price and parameters and back testing, there will be losing trades in a row that could set your account back almost 10%. But if you stick with it, eventually, of course, a good trading system will get you back, and that's what we want to see. So I can't say it often enough. If you have any problems, please contact me. I'm here to help. If you have difficulties interpreting the Elliott Wave for your trading, I'm here to help. Read carefully what I write. Bullish bias means pretty much a buy the dip. It's very hard to then say, well, where is the dip going to bottom? Well, that's what I'm trying to figure out myself as well, using standard-based Fibonacci retraces, all that stuff. And sometimes we fail completely in reaching those target zones. That happens. But in a bull market, you can be a little bit sloppy. So you could have bought 2-3 days ago, and 2-3 days later, you'll be back to break even and plus. Okay, that's the beauty of a bull market, because you'll know you will get eventually higher prices. It still doesn't mean you should just buy indiscriminated and just slap on a buy order somewhere. You want to, of course, try to get the lowest prices possible. But please remember that as long as prices are above moving averages in the Ichimoku cloud, it is a bull market until proven otherwise. Okay, well, with that, I want to wish you all a very wonderful weekend. I hope it's not going to be as hot as it is here in California. I'm getting tired of it. I'm getting ready for the fall. I want to see lower temperatures. I don't want to see higher temperatures. No, I don't enjoy it that much anymore after about 6 months of relentless warmth. It is time for the seasons to switch. And with that, have a wonderful weekend. Trade safe, take care, and I'll catch you all next week.